Hi guys, my name is Alex, and this is my finance project. For this project, we compared 10 different companies across 2 different industries. Our first industry is large pharmaceutical stocks, and our next are defense stocks. Now, the first company we're going to look at is Pfizer, or PFE. And here we have on the side, we have all of our different ratios, our fun stuffs we're going to be working with today. And then we have it spread across 5 different years. Luckily, they all managed to line up, so we have financial year 2012 all the way through financial year 2016. Now, our last column here is our trends column. So what I did was I went through and I looked at each one through all 5 years and notified if there was any trends. Now, for some of them, there's maybe a 5-year trend. For some, there's a 3-year trend. But in the end, a trend's a trend, so I went ahead and labeled those. For example, here, we have a decreasing current ratio, 2.2, 2.4, 2.5. So here it was going up, but this is a 3-year trend. So we have a 2.6, 1.5, and 1.25. So between those 3 years, it's decreasing. Because it's decreasing, we marked it as such and then colored it red. So that's just in general how our trends go. Sometimes there's no trends, sucks sometimes. And then over here we have stable trends. Now, I labeled a trend as stable if the numbers looked about right. So we have a 9.4, a 9.6, and a 9.62. Now that looks about right, but just to confirm my suspicions, we did a standard deviation here. Standard deviation between those 3 is 7.6%. And just for fun, anytime I saw something that looked about stable, I declared it stable if it was under 10% of the standard deviation. So we have a 7.59, so I declared that under 10%, stable. The one underneath that, we have our asset turnover, which is at under 1%. So that's as stable as it can get almost. And then just in general, we have our large scale. Now, some of these cells you'll notice are highlighted this nice yellowish peach color. Now, what that is it breaks my personal, what I look for in evaluating a company. Now, we're going to get into specifically what those values are in a little bit, but that's just something that makes me nervous as a personal investor. And let's go ahead and go over the averages. Alright, these last 2 columns I have here at the bottom of our spreadsheet, we have our average values. Now, what these average values are the average values for financial year 2016, which, as you'll remember, is the last year of what we're doing. It's 2012 through 2016, 2016 being the lowest year. So for all 5 companies, we averaged this value, whatever its financial year 2016 value is, and we averaged all of them for each company. So our average current ratio is 1.5, quick ratio 1.05, etc., etc. So those are our averages, which we saved for the last 2 companies in each sector, which we'll cover that in a second. And then my personal guide. Now, as you'll see, it's not completely filled in. That's because you want to analyze, but you don't want to overanalyze. So I picked my kind of top 10, top 12 different ratios, and it's my personal guide. For example, current ratio. I like my current ratios greater than 1. As far as a cash ratio, as long as our current ratio is above 1, I'm happy with. So then we have our financial leverage ratio. We want that to be under 10. Our EBIT over interest, or our times interest earned, to be greater than 10. We want our profit margin and ROA above 5, our ROE above 20, our operating margin above 10, our PE under 25. We want to find those fun ones that are undervalued. Our EVA spread, we want to be greater than 0 for 3 or more years. We want our enterprise value to be increasing in 3 of the last 5 years. And finally, we want our last price to be increasing. Now, we're going to go to the wide scale picture here. Now, the beauty of how I did this, and the reason I'm not doing a PowerPoint, is the way I like to analyze these companies is to take emotion out of it. Emotions are just going to have personal preferences, you're going to have biases, and my goal is to get rid of those. Now, the way I do that is as such. Here we have all 5 of our companies, 1, 2, 3, 4, 5, and then we have all our colored. We have our trends, we have our numbers that alarm us from my personal goals, and the averages we have at the very end just to compare to see if our last company really is really good. So if you look, we have this first company, and we have a lot of red trends. So the numbers might be good, but they're trending downward. We don't like that. We got a couple good ones, which maybe, and then we have quite a few alarming numbers here. We look at company number 2 here. Again, I'm not going to go over the name just because we want to take emotion out of it. We just want to look at nothing but the numbers and the trends and what they are telling us. We got a couple alarming numbers here, a couple good ratios, a couple bad trends, a couple bad trends. But in general, if we're comparing just those 2, there's a lot less alarming numbers and there's a lot less bad trends. So if it was just between these two, this one would win by my standards here. Then we're going to compare these. A lot of yellows. Not really too comfortable about it. We like it. But the point is large scale. So we zoom back here. We look at all 5 of our companies. Which one looks the best? Personally, I'm thinking this one here is my favorite. First off, there are no bad trends. Now, there's a lack of both greens and reds, so there's not a lot of trends in general. However, the only trends we do have are those good ones. And there's only 3 numbers that worry us here. However, if you look a little bit deeper, those same 3 numbers that worry us are the same 3 for all 5 companies. So that's telling us something happened in the industry and not anything specific. So if it's industry-wide, you can't avoid that just by picking a better company. So I'm cool with that. So considering that, if you look at all 5 of these, if we discount those 3 because something happened in the entire industry, then there's 0 wrong with this company. So we're going to zoom in on here, and we find out that it's Bristol-Myers, which happens to be in the portfolio. So just blindly, we picked something that was already in the portfolio, which, hey, that means we got good choices from previous years. Now, just to compare the averages here, we have BMY's current ratio, 1.5 versus the financial year 2016 average of a 1.52. So not only is it good and we like it, but it's even better than the average. Now we look at some of these other ones. Financial leverage I like, because our financial leverage is a 2.15 when the average is a 4.74. So about half the average, but overall they're still doing well with half the debt. So then we can go through some of our good increasing ratios. We have decreasing financial leverage. So not only are they half what all the other companies in the industry are, but it's even going farther down. We also have an increasing asset turnover, which is also good. We're borrowing less and selling more. Down here, our PE ratio is going up, so that means we're liking it. Our earnings are valued higher. And then our last 2 are our last price and our enterprise value over EBITDA. Both are increasing. Love it. Undisputed, BMY is the best for this industry. Now, let's move on over to defense. Now, defense, now that you already have an idea of my system and the trends and the things we already went over, we're just going to start large scale. Again, I'm not going to announce who these 5 companies are. I'll put it in the description. However, again, the point is no emotion, no personal bias, no, ooh, that name's a little bit more familiar to me, so I like that one better. No, just straight up, here's what the financials are telling us, here's what the ratios are telling us, here's what the numbers are saying. Not, this guy likes it, so therefore I like it. So we're going to go look at the overview here, and just looking at the colors, you should start to get an idea of who we like better. So we have company number 1 here. We got 1, 2, 3, 4, 5, 6 numbers that worry us. A lot of good trends here. However, we only have 3 or 4 of these that we don't like. So looking pretty good. 4 numbers we don't like. Almost every single one has a good trend, with these 2 decreasing, but sometimes there's some give and take. Over here, we got a lot of good numbers, some good trends, some bad trends. However, I immediately discounted this because all the numbers that are alarming are all in this last year. So if you look, last year is good, last year there's a couple, last year there's none, last year there's none. So it's not something you can say is industry-wide. This is something that's happening just with this company. So we have quite a few bad ratios, and we also have these numbers that worry us. I don't like this one. So then we're going to come here, and we only have 1 number that worries us, and 1 bad trend. We'll look a little closer into that. And here, we got 4 numbers we don't like, a lot of good trends. In general, for this industry, we have a lot of good trends. The defense industry seems to be doing well, just from looking at these 5. So if you just look at broad picture, what we like, I picked this one, just because we have only 1 number that worries us, and that was 2 years ago, and then 1 bad ratio. As opposed to the rest of them, there's no one else, quite simply, that has the trends and the numbers to back that up. So let's go ahead and zoom in on this company here. And it turns out to be Raytheon. So we're going to go through Raytheon. What's the thing we don't like? All right, our EVA spread. And our EVA spread was negative, less than 1%. Now, I get a company can have a bad year, and then they rebounded back immediately after with a 2.8% year value. I'm cool with that. Now, our 1 bad trend here is for financial leverage. And it looks like it's a 3-year trend, so we got 2.6, 2.9, 2.94. So yeah, it's increasing over a 3-year period. However, it's one saving grace if we zoom over a little bit and we check out this average is, let's see, our average financial leverage for the industry for the last year is 11.5. So the average is 11.5. Let's go ahead and head back. The average is 11.5, but our value is about 4. So we're looking at about a fourth, a fifth of what the average is. I can live with it increasing just because it's a fifth what the average is. So they have below already, maybe they're trying to catch up, maybe they need to stay competitive, whatever. One bad trend, and that number is nothing to be scared of. It's less than 5% when the rest of them are at 11. So for those reasons, Raytheon wins. So let's go ahead and evaluate our top 2. We now know we like Bristol-Myers and Raytheon. Now, if we just look big picture, we have BMY in the red here, and in the green, we have Raytheon. So, again, we look, the only numbers that alarm us here are our last price, which, again, that was the same thing for the entire industry, so we can really discount that. And for Raytheon, the only thing we have that worries us is this negative 1% 2 years ago. Now, again, I can live with that, and our one bad trend on both of these companies, our only bad trend is that raising financial leverage. However, the actual value of the financial leverage is low enough to where they're just trying to catch up. They're still way below the average. So we're good with that. So what I did to break the tie here, just because they're looking pretty good, they're both looking pretty even, was I took my top 10 financial ratios, and then, now this is my personal top 10. I'm not saying this is objectively the top 10 that should be compared. However, here's what we got. I've got current ratio, our financial leverage, our EBIT over interest, our asset turnover, profit margin, return on assets, return on common equity, our operating margin, our PE ratio, and our EVA spread. Now, let's go ahead and go through these. I went ahead already, so you can kind of cheat a little bit and see who won, and because I have it highlighted there. But let's go ahead and go through these. We have for our current ratio, 1.55 versus 1.66. Now, personally, I like these numbers to be greater than 1, and it is. Raytheon has a lot more cash on hand. However, I didn't choose a Victor simply because it's personal preference. Whether it's 1.5, 1.66, it's not a big difference, and it's greater than 1, so there's no clear, it just depends on how liquid you would like your company. So I just left that one blank, undecided, tie, whatever you want to call it. Next, financial leverage, our debt. We like debt, we don't like too much debt. Both of these are pretty low, 2.15 versus 2.93. Personally, I just think less debt in this case, so I went with a 2.15 with Bristol-Myers. But again, both of them are incredibly low. EBIT over interest, Bristol-Myers can pay their bills about 14 more times than Raytheon can. Now, whether it's because they have less bills or they're making more money, that's something we gotta look a bit deeper into. However, they can pay their bills better, they win. Asset turnover, we have a 0.6 versus a 0.8. 0.8 wins. You sell more, you sell more. Alright, the next 4 are swept by Bristol-Myers, so we have our profit margin. So they might be selling less, but they're making more money off it. Our return on assets is almost double Raytheon's. It's still about a modest 13%, but that's still quite good. Our return on equity, now we already know BMY has less debt. So it's kind of funny that their return on equity is higher, even though they have a lower debt, which usually cushions and pushes up some of the less fun companies. So their ROE is better. It's only about 8%, but 8% is 8%. Our operating margin is a full 10% higher than Raytheon's. Had to give it to them. And then our PE ratio, I gave it to Raytheon because it's a lower number, because we like our PEs to be a little bit lower, you know, try to get those dogs the Dow thing going. And then our EVA spread. Now, this is the EVA spread for year 2016. All these years are for the final year, financial year 2016. And so we have our 7.39 versus 2.8. So about 3% to 7%, BMY has to win it. And for all of that, we have decided for all 10 of these companies over 2 industries that our winner is Bristol-Myers. Very good.